Okay, so this week we're recording on a different PC. So if Tom's machine crashes, the recording will be kept, the room will be kept open. So on Tom's machine, he's got some particular specialist software to magnify the screen because he needs that to see properly on the screen from time to time. And that causes problems with GoToWebinar or vice versa, whichever way you look at it. So sometimes his screen crashes. That's why we've decided to record on another machine. So, Tom, are you ready? Good, right. Let's put your screen on. Yeah. Okay, so, is the screen up, Rita? Good, yeah. Okay, so I'll pass you over to Mr. Tom Williams.
Yeah, thank you, Peter. Yeah, hi everybody, Tom Williams here. Lovely to talk to you. And apparently our newsletter has been missing, and that's of course due to a guy who runs it all. That's Richard Petnell, and of course partner of Gavin. But apparently it's up now. It's definitely up, is it, Peter? Yeah, Peter's checked now. If I remember, you know, we religiously do that newsletter every Sunday, and naturally it's interesting to get some idea what's going to happen on next week. And if you read that newsletter, I think you'll find it's quite interesting. And I think that's a newsletter where we've typed out an article really aimed at newcomers, describing really what volume spread analysis is roughly all about. And so please read that, and I think even if you're familiar with it all, it doesn't hurt to keep repeating this stuff, because the markets do keep repeating themselves time after time. The same thing happens time after time. Now we're looking here on the screen for a 4-hour chart. Now 4 hours, right, okay, but this gives you a pretty good idea of, like, it's in a way it's as good as a daily chart, even better. Now I do apologize because it's all so simple, I know, in hindsight. So simple. But if it was there in hindsight, it must have been there as it was running. Now there's the first indication there, look. This is definitely a shakeout. When you see these bars plummet down like that, now there's no signal, I don't think, on this particular time frame, but there are certainly on other time frames. Don't forget, this is a 4-hour chart. Right. Now the significant thing is here that you have this shakeout here, which they love to do in the, especially the S&P 500. This is a ploy. It's like a desperate attempt to shake the market out. They ram it down, shake out many, many traders who have gone long, and they shake out people that, of course, got stops in. That's what the idea of this is. It's very profitable to, as they say, gun for stops, right, which is a technique in its own right. You need to study that as well. But that's a shakeout. The market recovers. Now, the significant thing is, I've mentioned this so many times recently, we see it all the time. There's a red arrow. What's that say, Pete? No demand. That means at that moment in time, the professional money are not participating in the up move because they're nervous. So what do? You all know what a test is? Immediately next bar, look, there's a test. Now, a test is more like a guy walking across the frozen ice in the winter. His big danger, he's going to fall through the ice. So what does he do? He prods the ice as he walks forward. That's testing the ice, right? Now, in this case, of course, the big danger to a professional player who's long is that other professionals are going to come in and pour supply on his up move, right? So they know when they test it like this that there is no supply. Now, a test, classical test, we've repeated it many, many times. So we look, see what the computer says. Bar is down, yeah, we know that, red bar. Volume is low. Wow, what's that mean? That's no supply. The spread is narrow. I'll be damned. Spread is narrow, look. That means there is no downward pressure on the downside. And wow, it's closed, well, it closed low. The ideal one, of course, closed the middle, but it doesn't matter. It's still a test. It's a narrow spread, right? And that's all they need to know they can go on up. Look, there's a low volume. Right? A test. And why is it a test? We know it's a test because of two things in the background. First of all, that sign of weakness, and of course, a shakeout. That's the two things that tell us it's a test. If they weren't there, perhaps, well, but we know for sure that's why the test is there, because you've got that sign of weakness and you've got the shakeout here. So that gives them the okay to forge ahead. So up they go, right? Now see, there's so much money involved, right? There's another sign of weakness here, right? This is probably, what's that say, Pete? Supply. Okay, fair enough. So what do? They test the market. There it is. Now let's see what the computer says about that. Right, so there's the test. So we've got, well, let's see what, here we are. Bar is down, yeah, fair enough. Volume is average, yeah, fair enough. Spread narrow, wow. So no pressure on the downside, that's why the spread's narrow. Close low, fair enough, but that's fair enough because don't forget it's volume spread analysis. So the volume is no volume, the spread is narrow, right? And we've got all these signs of strength in the background, right? A little bit of no demand here, but we've got all this. So we decide up it goes, there we are. And you'll find this keeps repeating itself. Keeps repeating. I mean, there's another one there. They're all over the place, look. So they are, what's that one say? That's a test, look. That's a 4 hour. Where is it? Here we are. Bar is down, yeah. Volume's low. Oh, it's very low too. Wow. Spread is narrow. Oh my, close low. Fair enough. So we know we're going to get higher prices. It's as simple as that. We know we're going to get higher prices. And so up it goes. Now, however, on some of these timescales, it's showing us that there's a lot of no demand up here in this top area. Now, what's interesting as well, these red arrows, look, showing a bit of supply. If you're a point figure expert, you call that, right, preliminary supply. Now, look, if you draw a line across there, right, lo and behold, there they go. They're testing that level, look. It's the level that's important. Look how they plummeted down here today, or whenever it was, 4 hours ago. Okay, they're testing that. And there is a bit of supply present. So we have to be wary here. There is supply in this market. And that's why you get these shakeouts like this. All right, it's a shakeout to It's almost like doctors resuscitating a patient and had a heart attack or something. The crash trolley. This is it. We call this a crash trolley. Right? They slam it down. Right? Much pressure and alarm on traders that are long. Catch as many stops as possible and even encourage people to short. And on the back of that, bang, up it goes. So this is typical. But now we're talking about scalping here. So, you know, it all depends how, you know, what you're trading. Are you long-term pensions? Are you short-term? Are you trading on the back of options, for example? Options are very lucrative. We've got quite a lot of people trade options. And of course, the ones that seem to make consistent money are ones that are not in there too long, because those options are controlled by real experts. Oh, it's all right. Yeah.
Hello, everybody. We've got a question here. Well, you were talking about low volume, Tom. The question is, isn't the volume low because of the time of day?
No, it's not. That's something you've got to clear out of your mind. What you see is what you get. Look, if you're a professional trader, you've got 50,000 contracts there. You're not going to, you probably won't even go to lunch. So get that out of your mind. Don't try to figure out what they're doing, because you'll never succeed. And VSA, anyway, gets around it because everything is relative. That's all we need. Relative volume, even relative price spreads. So forget about this is the volume low because it's lunchtime and all that nonsense. That does not work. That does not pay. Believe what you see. Unless it's an obvious holiday half day or something. But even then, you look at the price spread. Okay? So it's very, very lucrative to look out for these testing. But this here obviously looks like a shakeout here. Now there is a lot of supply around, right? And that's why if you look up here on some of these time frames, there's a lot of no demand. Can you put the continuous contracts up of the NASDAQ, Peter? Is that possible? Yeah, it's a daily thing, sorry. Is that it? Okay, sorry, yeah. Now, I was just looking at this earlier on. Now, even this chart, continuous contract, this is very, very interesting too. I know it's dead easy in hindsight, I apologize for that, but the more you look at this stuff, the more you recognize it or be anticipating what's likely to happen. And they keep repeating themselves all the time because it's how the markets work. Now we look on the low here, right, and bang, right, okay, we do appear to have stopping volume here. High volume on down bars, right? Narrow, the spreads have narrowed, right? But we know they like to have a little shakeout at the end of the, Wyckoff called it a spring, and there's a spring, there's a spring, look. Yeah, we call it a test, right? Wyckoff called it a spring. In other words, the professional money that are involved in this accumulation area here are fully aware that they're accumulated. They ram it down just before they start the up move, catch all the stops, mislead as many people as possible. Thank you very much. Up it goes. Now, again, what's this? A test. They're testing this shakeout, right? What's that say? Test. Oh, How amazing. How very amazing. The computer agrees with us. It's a test, look. A test is a down bar, right? A red down bar, narrow spread, volume is less than the previous two, right? Closing in the middle. That tells you there is no supply demand. Now, why are we so certain that's a test? Because of the shakeout in the background, look, here. What else can they be testing? They can't be testing anything else, can they? This is known as a test in the rising market. They see that, bang, they mark it up it goes. As Gavin explains very often, this is a gotcha bar. The idea is that if you miss this, actually what might be quite a good idea is that when you miss these, write down on a piece of paper, say to yourself, why did I miss that? Why did I miss that test? And answer it for yourself. What, were you paying attention? Were you out having a coffee? Didn't you believe it? What was the reason? Keep doing that to yourself. You're always writing a little sort of essay to yourself. It's a lot of work getting your head around this stuff to start with, but it's all very, very logical. There's no, you don't have to be a mathematician. I knew somebody that could hardly write a letter, and he made a lot of money. He's a trader. He could spot that and he'd be in. So up it goes. All right, but as you get up here, we notice there's a lot of no demand up here. No demand. There's a lot of, so we have to be careful here. There's a lot of no demand. That's of course why they shook the market out. Right? They can see that. Now tell me, are there any questions about this particular chart? Reese's looking at the screen.
Not yet on this one. There is one on the chart that we had a bit earlier.
What was that, Risa?
ES 4 hours.
Yeah.
Yeah, well there's one question from Tom here. How would you interpret the two widespread red bars on the ES 4 hour? So this is that chart. Yes, those, Tom. How would you interpret them?
Well, we know that the S&P loves to shake you out if possible. And that's a ploy they use. Apologize for the old seagulls. We're not too far from the beach here. Rita says we've got one.
He's waiting at the door.
So he's waiting for the door.
Did you feed him?
Occasionally, yeah, I do feed them, I must admit, sorry. Okay, I'll get back to reality here. Now, we know, historically, they like to try to shake you out. Now, we saw the no demand up here, didn't we, on that previous chart, or various other charts. There's lots of no demand up there. Right, so what ploy do they use? They use a shakeout. Now, we know that. So when it plummets down like that, right, it's plummeted down. Now, this bar here is also heavy supply on it. Or, well, I say heavy supply. I think this is when the market opened. But these bars have got these top tails. A bar with a top tail usually showing weakness in there as well. But here, because it's a down bar and the volume is massive, there must have been buying in there, especially when the next bar is up, look. If you see a green arrow, right, it tells you in the dialog box to ignore them unless the next bar is up. Now, when we get the new software, we'll resolve all these issues like this. All right, but so that's how I interpret this. I'm really being influenced by the background. Right, the background is, first of all, we know that they love shaking the markets out. We know there was no demand up here, therefore they want to shake the market out. If you want to go a little step further, if you draw a line through these red arrows here, where there was a bit of supply, look, lo and behold, they've come back down to that level. It's the levels that are important. There is a bit of supply. There's still a lot of supply here, look. So we have to be careful about letting this run away with us. Trends do run longer than you think they will, admittedly. But you have to let the market tell you the story, unfold. I know it's a game of concentration, really. And hopefully in the future we're going to have this software that's going to alert you when these, what I'm telling you, appear or occur, which would be fantastic. That's what it needs. Okay? So the market will keep repeating itself. It'll keep having tests, it'll keep having no demand, it'll keep having shakeouts as you go along. Now, what will happen, we know will happen, because it always has done for the last few hundred years, the end of these long bull runs, the end, right, will be marked by the market lurching up into fresh high ground. The volume will be very high. It'll probably close in the middle, and the news will be very, very good. Whatever the news is, it's going to be good. And that will suck people in, and that's why you get what we call the buying climax. It's been marked up, people rush in. Lots of them are fed up of watching this bull move going on and on up, and a lot of them are not participating in it. This can include banks, fund managers, all sorts of people, right? Because they're only human at the end of the day as well. Okay, so that's why I would interpret those two red bars. Okay, anything else, Rita?
Question here, what phase is the market in right now, accumulation or distribution?
Well, I'll tell you what, it's certainly not an accumulation. And I think myself that there's a lot of selling going on, and they're holding the market up, supporting the market to sell more on the next wave up. That's what I think is happening. But all we're really interested in, the way we trade, is what we call scalping. It might only be in there, Gavin scalps all the time. We might only be in the market, what, an hour, 2 hours, 10 minutes, whatever. But that's why your skill as a trader has to develop. And if you concentrate, you look at, say, a professional trades corn. He wouldn't dream of trading anything else. He's a corn trader, and that's it. He won't trade anything else. That's what he specializes in. That's what he's become good at. And it's like, you know, if you've got children, you more or less know what they're thinking and doing through experience. You specialize in their behavior, especially with women.
There's a question about these bars here, Tom, on this, I think, here. you have, this is the 21st of August, we have a red down bar followed by a blue up bar, and both these bars have red triangles, question mark. And then I'm not quite sure what you mean by this, but I'll read this out. The testing of the closing prices of these two bars. Is that a question? Is this the testing of the closing prices? Or I'm not quite sure. Yes. So are they testing the...
When you see weakness come in the market, right, professional money is fully aware of that well before we are or you are, right? So therefore, the big danger to them is other professionals dumping their holdings on them. So what they do, they test the market. And as soon as you see a test and the other professionals are not interested in dumping their holdings, you know it's positive for them to go up. It's got nothing to do with the close or anything. It's a test as a bar in its own right.
Is the test based only on the close of the blue bar?
No, it's not. Nothing to do with the close. The close, you know, don't get too complicated. Don't try to be too clever. Don't try to think, oh, they're going to lunch or this or that. That's all that's going to confuse you, right? Don't forget, everything is relative in VSA. So we can get away with millions of missing volume or extra volume because we know we can't trust them totally. Why do you think if you look at the commodities, the volume doesn't come into the next day? Why? Think about it. Because volume to a professional player is so important. That's why they won't let you have it if possible.
Right, we didn't ask at the beginning if we had any new people, but it's clear that we do have some new people in the room, Tom. There's a lot more people than we normally have as well. So I've had this question. Can you explain to us how the new person can use VSA? What is VSA and how to use it? So, I mean, obviously there's a lot of study that you can be put in, but Tom can give you some kind of overview, can't you, Tom?
Right, the first thing I would tell you is to read the very, very latest newsletter. Now, it's 2 weeks old for various technical reasons. Well, we do our duty here. We get it out on a Sunday. Then it's left to the gods to technically get it up there, I suppose. But read the last newsletter. And Rita and I, we've typed out an attachment to the end of that newsletter telling you what VSA is all about. Read that. Because if you could read something and then absorb that, that would be a hell of a, shall we say, leg up for you. In this business, we don't use any mathematical formulas. We don't need to. Right? The chart is a language. The chart is a story unfolding in front of your very eyes, telling you the balance of supply and demand. Not all that clear at sometimes, but don't forget you've got multiple time frames to check up on. So Gavin keeps throwing all newcomers, which I welcome you. We love to have new people, but please read that newsletter. How would they read that newsletter? Where is it? On the website.
Well, that newsletter is posted in the VSA Club.
Can you read it out?
And we can post it onto... Oh, it's already actually... I'll type it in here, because that particular one... www. I'm just typing something .co.uk. Okay. So that particular one we put onto another website that we've just got for Tom. Just that the article. Oh, well, we're talking about the newsletter.
Tom's talking about the bottom newsletter.
Oh, well, that article is on that particular website there, and the newsletters are I'm just typing in. I can't talk and type at the same. VSAclub.com. Right. No, a new TV. That depends if it works. Yeah. We're back. Hello everybody, I think, can you hear me now? Yes, I can hear now. Good, I really apologise about that, but as we said, Tom's got this software that he really has to use, and it causes his computer to seize up only when we're using this GoToWebinar software. So there's obviously a conflict somewhere, and we're back. Anyway, now we're just bringing up the I've forgotten where we were. We were talking about the newsletter. So for new people, obviously, yeah, newsletter, it's education. And there are books about VSA written by Tom Williams, written by Gavin Holmes. Gavin's coming on this in 25 minutes, 6:30 UK time. Personally, I read Tom's book, The Undeclared Secrets That Drive the Stock Market, 3 or 4 times, and then I started to apply it myself, practicing and practicing. So it's about educating yourself. It's about recognizing the importance of volume, very high volume, and the VSA principles that are mentioned, and you'll hear them over and over again: test in a rising market, no demand, all sorts of principles, and those are what you're looking out for, and they're the principles that Tom talks about. So it's sorry, I'm trying to speak and read people's messages. Okay, all right. Jerry, thank you. I've seen your words. Well, they can look it up, because that'll take up about 20 minutes. Well, I'm just thinking, so I hope you all got those 2 links, and especially the one, volumespreadanalysis.co.uk. Have a look on there. There is the article that Tom was just asking me to, so you can look at that later. So yeah, it's Tom. There's a group of people here who don't know a great deal about VSA. So if we can keep that in mind when we're talking about the charts and showing them stopping volume followed by tests and all that sort of thing, would be good. Right. There have been some various requests for crude oil, and maybe if we see some principles in that chart.
Right, okay. Gavin would love to talk about crude oil. That's one of his favourites. I've got a feeling it's weak. But, sorry, now, yeah, you look at these, you look at some of these signals, right? Supply, right? Now, the idea of the signals, stopping volume, they're for your education. So when they appear in another chart, another time frame, another time, you will recognize it. And they all look very similar, these principles. Now, the reason I mention this is because we can more or less prove to you by looking at these automatic signals that have no human being has anything to do with, right, at all, apart from the programming that was done 10 years ago. These signals, most of them are 10 years old at least, and they still appear. They appear because this is how the markets work, and they always will do. They have to, because that's the way supply and demand portrays itself. So in a way, we have proof telling you that if these signals appear quite good, then that means that the logic that we've informed the computer by a programmer has to be correct. Computers do not understand mistakes in your thinking, flaws in your logic, just doesn't want to know. It's like a phone number. Get 1 digit wrong and nothing works, right? A computer's not capable at the present day of saying, oh yeah, that 8, that's a 3, look. So we'll try a 3 and we'll get going. Doesn't want to know that. So you have to get the principles correct for anything like this to work. Now, the problem is, on the surface, yes, it may look quite easy, but believe me, I've had 8 programmers I've employed over the last so many years. These are clever guys from universities and that. And the trouble is, you don't get anything out of them because they don't know what you're talking about. They don't understand it. I think a programmer has to understand the underlying logic to be able to program. And hopefully, I think we found a gentleman called Gregory who resides in Moscow, right? And he seems to have grasped it, or has grasped it. He actually trades as well. So we hope that in the future we'll get something really, really outstanding. But the logic has to, underlying logic has to be right here. Now, are there any questions that we can answer for you at the moment? Now this is a 20-minute of the S&P 500. Now, so, okay, so we've got a shakeout here, right? We know there's no testing here, right? This looks like a markup on no demand look. So we have to be very wary here. I would not be at all surprised if this market has not been artificially held up so they could sell more in every wave up. But right now, if you see a test of this market somewhere now, the next hour, say, or so, that's, you're going to get high prices. A test is a down bar, be a red down bar, right? Just indicate it's a down bar. Down means that the close is lower than the close of the previous bar. Now what we've done, or I've done here, I've colored it red, so it makes it obvious it's a down bar, right? The spread will be narrow. It'll probably close in the middle, and the volume will definitely be low. That's a test. If you see that, you're going to get higher prices. Now, you have to use your imagination a bit. Perhaps it won't close on the middle, and perhaps it might even close on low. But the main thing is, if the volume is low and the spread is narrow, those are two main criteria for test. And why should we have a test? We would think it was a test because this is the background. This is a shakeout. And that's what they do. It's a ploy to get higher prices. Any questions?
Okay, so you're not going to do crude oil then, Tom. We'll leave that to... Let's put crude oil up then. Oh, we need the end of day. There's one here, while we're putting that up. What specific advantage is missed in traditional technical and charting analysis that VSA is using to capture alpha? What specific advantage is missed in traditional technical and charting analysis that VSA is utilizing or capturing?
We do not use technical analysis, right? Now, what I say about technical analysis is, in my personal opinion, right, is that out there in the trading world, there are some very, very clever people. There are people out there, I think, that might even put Einstein, Faraday, and Thomas Edison in the shade, right? Now, if there was a formula, right, where 2 and 2 made 4 and all this stuff, right, if there was something out there that did that, then these clever people would be onto that many, many moons ago. They would have spotted it. Same as you would spot a bargain if you knew in your particular town or village or wherever you lived that there was a money-making opportunity. You'd be onto it. Now the fact is that if it worked, professional money would be pouring money into that trade, and it would dilute the signal. It wouldn't be there. Certainly wouldn't be there in hindsight. It would be traded out of existence. And that's why technical analysis only seems to work very, very well in hindsight, because nobody sufficiently was trading that in sufficient amounts. Now, we don't use mathematical formulas. We don't use any formulas at all. The only formula well, there's two we might use. Trend lines, yes, they're wonderful. And 50% retracements. They seem to work. But we do not use any of these formulas. And you'll find that you can look at a chart, sit there, and within a few seconds you can more or less sum up that chart and know whether it's good or a bad chart. That's what you will be aiming for, and that's what will happen. And remember, once you learn to read these charts, remember, a chart is a language. It's speaking to you, it's talking to you, right? You will have that skill with you for the rest of your life, and you will never, ever regret it. I can assure you there, never.
Okay, we've got the crude oil chart up now.
So some weakness back here somewhere, must be. Right, this is crude oil. Now, here we're looking at the old top look. First of all, it's overbought. That means it's above the upper trend line. Right? And of course we have signs of weakness here. No demand. Right, up it goes. There'd be no demand there. And a nice, there's not a signal on this particular time frame. But look how they rammed it up there to catch the stop, knowing full well it's weak. So down it comes, trending down. Right. In a weak market, you'll find that you get these blue up bars, no demand. Now, there's not a lot of signals on this one. Now it's hit the lower trend line here. And there would appear to be a little bit of support, not a lot. A little bit of high volumes come in, look, which is understandable. There are professional traders who trade on these trend lines, believe it or not. To me, this still looks weak. Gavin will be here at 6:30. He loves crude oil. He specializes in trading this. He's the boy to ask. But to me, it looks weak. There's just a little bit of stopping volume, which is understandable on that lower trend line. Now, if that pops up, right, which is likely to, you may see up thrust, no demand, along here somewhere, then you know it's still going to come off. An instrument has to have what we call a cause to move up. A cause is when professional money move into the market and start absorbing and buying that instrument. There's a little bit there due to that trend line, but that's about all I can see at the moment.
Well, we've just been asked for some comments on gold. So this is the continuous contract for gold.
That'll be all right. Gold, right. Well, first of all, we can see the reason why it's come off. Look at this distribution cap here. Right. There's the initial supply coming in. Look, markets. Excuse me. Markets do not like ultra high volume on up bars. They do not like it because it means selling. If the professional money want to unload, they have to unload in a rising market. So up it goes, they're unloading here. Now they have what we lovely call an upthrust. Now Rita tends to specialize in upthrust. It's not a true upthrust, as you'll see if you put a study to it, but certainly supply overcoming demand, and that's what it looks like. Professional money will be fully aware of that, right? They've even tested a little bit, but up it goes, and I know without even looking at the volume, it's got to be no demand in there, right? And then they're fully aware of that weakness, so they have this widespread down, bang, and notice how the simple, what I call the simple trending system works, right? All the time the bars are red. They do that deliberately because they do not want you to be able to cover your losses. If you're up here and you're suddenly caught in this down move, you're stuck there, and you're thinking, they know what you're thinking, right? That's why they do this. They know perfectly well you're thinking, ooh, don't like that. When that market goes back up, I'm getting out of this. They know that, but they don't let it go up. And that's why these bars are persistently red like this. They're locking you in the trade. Okay? So crude oil, to me, still looks weak. But Gavin tends to specialize in crude oil.
That's gold. That is gold.
Sorry, it's gold, not crude oil. So that's gold. So you've got distribution up here, right? Which I know is very, very easy to see in hindsight. I'm sorry about that. But gold starts trending down, and to me that looks weak. Whenever you see a widespread down, close on the low, with a very slight increase in volume, that's normally bearish as it rushes towards a former area of support. And the former area of support is that trend line or resistance. Don't forget we're overbought here.
Question from Winston. VSA has told us how to identify a strong and a weak up bar. What identifies strong or weak down bars?
What identifies weak down bars? Well, it's a background, isn't it? I mean, when you see a serious down bar, say like this one here, look, right? Although it's closed in the middle, there's no response in the market, right? It's still going down here. The reason why we think that's bearish is because of this background. Once you learn to recognize the distribution area, that is how distribution areas look like. That's what they look like. They look like up bars of very high volume. They like to have up thrusts, right? They may test the market because they want to hold the market up so they can sell more, right? Convince you it's going up. So they hold it up, readily market up, look. There's no progress to the upside, and then that's what marks a weak down bar, is the background. And look at that high volume too. If that was stopping volume, well, it won't be stopping volume, because it's stopping volume is at a price level that has become attractive to professional money. Now, it can't be attractive level, it hasn't gone down far enough. It'd be different even if it was here, look. At least it's fallen quite a bit. But here, it can't be stopping volume, even though you've got massive volume, it's supply, because it hasn't fallen enough. You might be interested in buying a house over the road, right? But unless it was offered to you at very, very cheap level, which you would know because you're expert on the prices of your area, you won't be interested in. It has to reach a level which becomes attractive to the professional side of the market. Anything else is what Gavin calls a gotcha bar. In other words, it's deliberately marked down viciously like that to lock as many people in or out of the market as possible. Don't forget, professional money, they know how you react. They know. I usually describe it as if you're a fire chief and you walk onto a stage in a crowded theatre, put your hands up and says, "It's a fire." You know what's going to happen.
We're expecting Gavin Holmes to join in a few minutes, and so I'm sorry that we haven't been able to answer every question. There's a lot of them, but maybe he will be able to. He should be able to see your questions. But Tom, do you remember? There's a question here from William. Comparing the ES with its shakeout after no demands. Do you remember you talking about that? Let's 20 min. Oh, that's it there. Then should we be looking for possible shakeouts on the Nasdaq after we see the number of no demands?
We just put the 20-minute up, and lo and behold, we appear to have a test. There it is. I hope you can see it all. Let's see what the computer says it is. There it is. Right. If you were describing a test in a book that you were writing, you'd say the bar is down. Volume is low, very low. Spread is narrow. Wow. And it closed in the middle. That's a perfect test. Right? You would expect on a perfect test higher prices. That's how you would describe it. Now, I mentioned before, look out for a test. And lo and behold, there's a test. Okay? That's the language of the chart talking to you. You don't have to worry about are they going to lunch or what the hell is going on. You know they tested the market and there is no supply. And the reason there's no supply is because you've got this shakeout in the background. There. So, there's a test. What more can I ask for?
Did we answer the question there? What did you say about the Nasdaq? Yeah. So it was, should we be looking for possible shakeouts on Nasdaq?
No. The Nasdaq will move in harmony, more or less, with the S&P 500 and with the Dow Jones. Don't expect one to go one way and the other way, because it just won't happen. It will go in harmony with the main indexes. So don't think one's going to do something It may not work in perfect harmony, but it won't be far off.
On the subject of tests, do you want the test to go into the volume bar?
Don't start getting technical. Don't start saying, oh, will it do this, will it do that? A test is a down bar, narrow spread. Volume is less than the previous, usually less than the previous 2 bars. All right, so we look down here, and I believe it is, look, there it is. Less than the previous 2, and on that, it's close in the middle. That's why we call it volume spread analysis. You're analyzing the volume or activity, and when that activity will happen, you would expect higher prices.
In fairness, though, also there is that when we have stopping volume, isn't there, at the bottom of the chart, and it comes back down the test. So that is a principle. Yes. So if you have, can you take your magnifier?
Yeah, sorry.
Off. So do you want to mention that, Tom, about that? Yeah.
Right. Once you see, say, should we call it a bit of a bear move, right, for the market to go back up, or the market you're watching, you normally expect to see what we call stopping volume. That is, the prices have become low enough to attract professional money. We're talking about 50,000 contracts or more, right? It will be what we call fresh low ground. This is an ideal stopping volume. It'll be a narrow spread. It'll close in the middle or high. The volume will be very high, ultra high. Now, you don't jump in and buy on that because you know, right, that they'll want to test that. So normally, true stopping volume, you see 2, 3 bars go up. You might even see an up thrust. You might even see a red arrow. It'll start rolling over a bit. Now, the thing is, it's a level that's important. Forget about all the numbers and all the rest of it, right? You're looking at this visually. You're reading the language of the chart. If it falls back down into that area where you first saw the stopping volume, and the volume is now low, right, it's telling you there's no supply. It's all been absorbed. Therefore, that market's going to go up. That's a principle. We see it all the time.
A comment here from Chris for you, Tom. I don't know why, but today's commentary has been like someone switching the light of understanding on. Thank you. Keep up the good work. Thank you, Chris. Right. We're hoping that Gavin's going to join us. Gavin, are you there?
I am here, Rita. I'm in the background. Can you hear me? I've typed it in.
Yeah.
I'm here.
Oh, okay. Hang on.
Yeah, hi everyone. It's Peter again. Yeah, so Gavin's now here on the in the room, and he's going to take over. So Tom's done his bit, as Tom says. So I guess it's over to you, Gavin.
Yeah, thanks a lot, Peter. And can everyone hear me okay? Let's do a sound check. And thanks to Tom and Peter and Rita. Welcome to you all. Let's just do a sound check, and let's thank everyone over down there in Worthing for a great seminar. Got lots to show you today. I'm going to be with you here for about another hour, hour and a half. I'm in 2 trades at the moment. I'm just about to take a 3rd. So should be quite a good afternoon. Okay, good. Can everyone hear me? Let's just do a quick sound check before I start. You should be able to see my Scoop It page on market manipulation, which has just been picked up by the BBC, which is quite interesting, which is the British Broadcasting Corporation. So I will tell you more about that later, but this seems to be working quite well. I only launched this 2 days ago and I've had over 3,000 views from people who've never seen this before, and it's getting a lot of traction at the moment on the internet. So we'll talk about that as well.